Hello everyone, this is Matthew Frailey with BreakpointTrades.com. We've been bringing you advanced technical analysis, market commentary, trade ideas, and mechanical trading algorithms like you see here. We've been doing this since 2003 for individual traders and professional institutions, which I consult with on a daily to weekly basis. Okay, so let's go ahead and get started. This is our back-end newsletter system, as you can see here. And this is the newsletter recording for Sunday, September 25th, 2022. Okay. I hope everyone has had a nice weekend so far. Again, it's Sunday afternoon, about 3:30 p.m., September 25th. Okay. As you can see via the table of contents, this newsletter is divided into 7 major sections. Okay. If you are new here to Breakpoint Trades, these weekend newsletters tend to be quite comprehensive and usually take about anywhere from 40 minutes to close to an hour. This one will probably take about 50 minutes or so. Okay, very comprehensive. We cover everything in great detail. Also, I suggest that you subscribe to Breakpoint Trades or at least get on our free list so that you can see some of these emails from newsletters from time to time. I also suggest that you pause the newsletter audio and read over my detailed text here under the table of contents. But, you know, one thing I've tried to do is organize this. And I think I got a pretty good format here. So first off, the trend of the market, bear market, long term, intermediate term, downtrend, short term, downtrend. Okay. Steve and I have done a very good job this year. And again, we don't like to toot our horn, but we've done a good job. We warned about a bear market way back in December of last year, guys. You can go back and review our newsletters from then and our videos. And then we confirmed it shortly after in early January. Plus our KISS trending systems, which are more designed for, say, 401k type systems where you have long-term money exposed to the market. They've done their job well this year by staying out of the market and keeping you safe. They did go long once or twice, but they got out the last time for actually a profit. They've done well. The 22 reversion-to-mean systems that we have killed it this year. There's been almost 50 trades between SPY and ES. Okay. That said, I'll cover that below shortly. As far as the market, as you know, last week the Fed raised the overnight rates by the expected 0.75 of a point to 3 to 3.25% overnight. However, the Fed was extremely hawkish, which again, Steve and I just are flabbergasted how the market was, taken aback by that, because the Fed has done all year long what they said they were going to do. And anyway, on the hawkish comments, the market sold off mid last week into Friday. The charts are ugly. There's no way to sugarcoat it. For the week, the S&P lost 4.65%. The NASDAQ gave up 5%. The Russell 2000 gave up 6.5%. For the year, the S&P is down 22.5%. The NASDAQ is down almost 31%. Okay. Now, very short term, market is quite oversold. It's near the June lows on the major indexes in most sectors. So we could see an oversold bounce here. We have indicators that are very extreme levels. Some of them are record territory. That said, if we get a bounce here, I don't think it's the bottom here. From a wave count perspective, we're likely in a wave 3 of 3. A rally from here would be a wave 4 of 3. Then we go down again in a 5 of 5 or a 5 of 3. Need to correct this typo. Okay. Anyway, again, I'll cover all that below. A few other things. Bonds, 10-year closed at 3.7% for the week. By the way, 30-year mortgages, I just looked, are now near 7%. Think about that. And that is starting to finally wreak havoc on the housing market, which we warned, way back early in the year. TLT lost 1.3%, but we are looking for a potential falling wedge there. The yield curve is now the most inverted it's been since the 1980s. So we got a very wicked recession coming. Currencies, US dollar rallied almost 3% for the week. That's unreal. Okay. The $1 is now worth more than €1. And also, we're nearing parity with the British pound. Think about that, guys. The US dollar is almost equivalent to the British pound. I think it's at 0.93 to something like that. It's pretty close. All right. Again, I already covered the various systems here. So let's go ahead and move on to the rest of the newsletter. Item number 2 shows the index sector table, what transpired last week. The indexes, major indexes are at the top. Again, bloody sell-off on basically Thursday and Friday. Down for the week, major indexes down 5 to 6%. Major market sectors, we follow 20 of them here. Every single sector was down. Remember, guys, in bear markets, they eventually come for everything, okay? All year long, energy held up the best. But again, in a bear market, what holds up eventually gets taken to the woodshed. And that's why last week we presented a short on energy. Oil services, we showed a rising wedge, we showed bear flags and the weekly patterns, and those played out. In fact, the energy sector was down the most. Oil services down 12.8%, XLE down 9.2%, the weakest sectors in the market last week. Currencies, US dollar up 3% for the week. That's unreal. The dollar has been going parabolic. Okay, cryptocurrencies, we're holding up. In fact, they're actually down here. This table didn't update. Let me redo that. Anyway, moving on. Commodities, bloody red for the week for the most part. Wheat and coffee were up a little bit. But, strong losses here for the commodities. The general index, DBC, was down 3.5%. Crude oil down 7%. Remember, we showed it as a bear flag a week ago. That played out. Natural gas, we were shown as a head and shoulder pattern, down about 10%. Precious metals, well, they just can't get going anywhere. Obvious effect with that very strong US dollar. And of course, you can see the movement in bonds here. High yield corporate strongly down with the market. TLT down. 10-year, 30-year strongly up. 10-year treasury yield up at almost 3.7%. Next. Item number 3 shows the economic news calendar for this week. You can see what's on the docket here. We have home prices on Monday. Actually, this is Tuesday, and durable orders. Really nothing on Monday. Market's going to move more on the technical charts and action. And let's go ahead and jump into the charts. So the first thing we're going to discuss is the systems. Okay, so this is we're going to discuss the KISS systems. These are trend following systems. There's something I designed a couple years ago. They're designed mainly for folks who have 401k plans where they have it in the market, S&P and other related major indexes, and they want to be in the market during general uptrends. They're not trying to trade those long-term accounts, but they want some sort of protection. Okay, so think of the KISS like insurance. The DVT is basically your insurance get out of Dodge price. So this is the weekly view of our KISS trend system. You can see it caught that trend from the 2000, the March 2020 timeframe, and then this DVT at 4370 was hit. Zoom out a little bit, was hit back there in early January and stayed out of that whole downtrend. It then did take a quick long there in July, early July. It then price stalled at the ATR here, and it then got out at this DVT, and it actually made money there. So it's done a good job about, keeping your 401k long-term accounts out of trouble. Doing its job. Next. Image number 5. Here's the daily view of the KISS trend. So again, now the daily, a little more active than the weekly. The daily, again, it got out of there in early January at 45.95, great price. It then took a little brief long there in March. You could see had 2 DVTs, higher low stops and got out. Then it attempted another long there in July. It stayed in about 4 to 5 weeks. It got out at the 40.88 DVT. Actually made money on this, and it's been protected and in cash since. So it's done its job very well. Now, a couple things on this daily KISS chart. We do have a DeMark 9 here. Last time we had a DeMark 9 here. Again, prices can go below DeMark 9s, but that is, short term. It is a notable event. A lot of traders also realize this, but we could get a short-term oversold bounce based on that. You can see how that last rally stalled perfectly at that ATR trailing stop that we used, just perfect. And moving average ribbons, you can see had a bearish pinch back there. Also, if you're wondering, or if you don't know, the A's on here, they've been really good. At all these peaks, we get these little A's that show up. What are the A's? It's amateur buying. Basically, it's showing declining volume with rising price, and so it makes sense logically. Next. Now, let's go ahead and move to the reversion-to-mean systems. So we have 22 reversion-to-mean systems, which we give trade signals on the website for both SPY and ES instruments. Okay, and because we're in a bear market, these systems are very active. They do well in bear market conditions because of the volatility. Now, unlike the reversion-to-mean systems, or unlike the KISS trend systems, which are trend following, they've been in cash most of this year, and they took a long in July to August, and they got out. The reversion-to-mean do sort of the opposite. Think of these alike as rubber band trades. The market gets too stretched one way or the other. They see a trade opportunity, they get in and get out. The reversion-to-mean systems, they have high probability, usually around 90% winning trades. And again, we use 22 different systems. That way, it gives us a good broad diversification. If one of the systems were to have a bad trade, usually one of the other systems will make up for it. That was my thought with having all the different systems doing their own thing. But the one thing I want to point out, guys, is the reversion-to-mean systems have started to go long on this sell-off. So here's the active systems now. At the top, we have the SPY system. We have the bear long is in a second entry as of Friday. We do have the Stoke reversal short, which took a short 2 weeks ago, and that's actually helped to offset that long on the bear long a little bit. The system here on the upper right, that's the QE 3.2. It's not in an active trade, but should we get lower prices, that could trigger, and that's probably one of the best or highest statistical trades out of all of them. Has 100% winning trades, and it usually only ever goes long at major bottoms like March 2020, March 2008, December 2018, things like that. So this system here could trigger active should we go lower, okay? Which we are overall expecting, but we'll see if we get a bounce here in the short term or not. At the bottom is ES. It also has a second entry on the bear long. And yes. So the one thing about reversion-to-mean systems, they're tough to follow initially. They're not feel-good systems, and many of you are aware of that, because they're buying when things look the worst. They're buying when things feel, when the negativity is the highest, and they sell when things feel the best. So they're not feel-good, easy systems, but overall they do, have a good track record, and they've killed it this year. But, should the market go quite a bit lower, these systems could take a little bit of heat before they finally get out. So you should be aware of that. Next. Image number 7. Here's the current open system. So again, like I said, on for SPY, we have one short from the stochastic reversal, and we have the bear long first and second entry. For ES, we have the bear long first and second entry. Next. Just showing these trade tables. Here's the trades that have occurred this year. Again, there's been a lot of trade signals. So these are the trade signals for SPY. There's been 46 of them. Again, we have the open trades here. At the moment, here's the total gain for the year. If you did these via what I show here, $10,000 per trade, which is very conservative. Next, image number 9 shows you the trade list for ES. And you can see the active trades here. The ES would be up 42,000 if you took these trades. We actually do MES, which is the micro contract, which is 1/10 of ES. So $5 per point move, basically. Okay. All right, let's move on from the systems. Let's go to the general market analysis. So first chart here, item number 10 is a yearly chart of the major indexes. So each candlestick represents 1 year. Okay. So as of September 23rd, Dow's down about 19%, S&P 22.5%, NASDAQ around 31%. By the way, commodities, which were up at one point, 20% or 25, 35%, they're now only up 15%. Remember, in a bear market, everything eventually gets hit. What's not shown on this chart, it's being cut off, is TLT bonds. TLT is down 27% for the year. Next. Chart 11 shows a monthly view of the 5 key major indexes with simple Bollinger Bands. Again, you can see my comments here warning this late last year in November 2021. I talked about this steep uptrend was a blow-off, and that was unsustainable. I mean, these charts really give you a good guide. I mean, you could see we had that bear market in 2008. We had a normal bull market from 2009 all the way to about 2019. We had that sharp sell-off. And then what happened is once price bottomed with all that liquidity pumped into the system by the Fed and the government, it pumped up all asset prices, and price literally went, you could see the degree in slope change from here to here. The slope change basically doubled. And this was a classic blow-off to that previous bull market, and now this is being worked off. You can see the Dow's below its lower monthly Bollinger Bands. The S&P is tagging the lower monthly Bollinger Bands. By the way, a 38% retracement from the previous bull market low. Is it 32.30? By the way, bear markets typically retrace at least 38% of a previous bull market, or 50%. So that could be some long-term targets on the S&P. The NASDAQ is down around its 38% fib now. Next. Chart 12, here's a weekly view of the 5 key major indexes. Again, start of the bear market there in essentially January, lower highs. And quite interesting, that last rally stalled perfectly at the downtrend line, connecting those 3 major rallies this year, and also corresponded with a perfect retest of the 200-day moving average and rejection. Here on the S&P, again, you can see we're essentially near the June lows. We'll see if we get a weak reaction bounce there. But I don't think this is ultimately going to hold. If we get a little bounce here, ultimately I think we go quite a bit lower this year before putting in a pretty decent low, and then maybe a pretty decent rally in 2023. Okay, but right now we got a little support in here. This would be your next support right around this 3,500 area. Okay. Again, all these indexes have essentially the same look to them on the weekly time frame. Next, let's go ahead and move on to the S&P 500. This is our proxy, which we usually focus on the most. So here's the monthly view of the S&P. And again, guys, back in January, we confirmed into that previous bull market and the start of a bear market. This is the chart we showed, this uptrend channel from the 2009 lows. We showed that as the 5th wave high. Most of the other Elliott waivers out there were calling for a wave 4 pullback. Clearly they were wrong, and we were right on that. So you can see right now we've pulled into around the 50% area of this channel. I do believe over time we'll pull back at least to this lower channel line. That's around the 3,200 area. Okay. Next. Chapter 14, here's another monthly view of the S&P. Shows you that same channel. So back when we had that bounce in June into July, I said it would fail, form a lower high, then come back down, and that's exactly what's occurring. Now, what I show here is a very nifty thing. The 14 link stochastic on a monthly time frame, whenever it falls below 50%, that clearly identifies bear markets, and you can see that happen this year. Again, we confirmed a bear market well before that in advance. We confirmed it back in January. This fell later on, I think March, April sometime. But next. Chapter 15, here's a yearly view of the S&P. And again, very simple to understand. Now, this is a linear chart. But what I have here is each candlestick is 1 year. And I have the 9 EMA here. So the 9-year EMA. And so, again, quite simple to understand. Reversion to mean, price gets too extended and eventually reverts back to the mean, which is the 9-year EMA, like it did here, like it did here. And it did revert back to it, actually undercut it here in March 2020 before recovering. But look how far we still are just from the mean. We're something like 500 points away still from the 9-year EMA. And I think under a real true bear market, which we're in, you would ultimately go below this quite a bit. So that does support some of our longer term targets down in the 2000s. But again, very simple to understand, guys. Price got too extended, and we're likely to revert at least back to the mean, the 9-year EMA. Still a long way to go. Next. Chapter 16, here's another monthly view. This is a chart we were showing early in the year. We talked about that blow-off move. By the way, guys, blow-off moves usually retrace all the way. So my concern longer term is we may need to retrace this whole move from that March 2020 low. Again, I don't think that's going to happen this year. That won't happen this year, not unless Putin launches tactical nukes or something like that. But that's something for a later time of the bear market, not now. But eventually it could go down there. But this demand zone and around the 32, 3,300 area is one of our targets, perhaps this year. Next. Chapter 17. Here's another monthly chart. It shows you the uptrend line for the 2009 low, that demand zone. And here at this second thin trend line here connects the bodies instead of the tails. And again, even that comes down there around the 3,400 area. Next. Chapter 18, here's a fun chart. This goes back to 1974 low. Again, connecting those major lows from 74 to 82 to 2009. And you can see the uptrend channel from the 2008 lows, 2009 lows, I mean. So again, at minimum, I think price will go down to here, to this channel. But could price eventually work its way down? This is a big support, 2,200. But, man, if things were really bad, could it eventually test this long-term trend line? Quite honestly, I wouldn't put that out of the picture either, just given the backdrop of everything. So we'll see. But again, that's not something we have to worry about short term. I'm just preparing you guys. This isn't your, something that a lot of you are used to. A lot of you have recency biased, and you're just used to the Fed, constantly bailing everything out. And a lot of you haven't been through a real bear market either. A lot of advisors haven't been either. Next. Chapter 19, here's a weekly view of the S&P showing this expanding triangle. You can see price stalled right at that 50-week moving average on that rally into August, just perfect. Also corresponded to the 50-day or 200-day moving average. You had the bearish moving average pinch there. So again, you can see right now price is basically testing the June low. So maybe we get a little reaction bounce here. But otherwise, you have the 200-week moving average. To me, logical to test that at least. That's not very far away. Then you have a support around 3,500. Okay. Then after that, your next support would be down around close to 3,200. Next. Let's move to the daily charts, smaller time frame. So chart 20, here's the daily. So again, you can see we're now at this June low. We'll see if we get a little reaction bounce here. But again, guys, look where price stalled out at in September. I said this was major resistance here. You could tell from the volume by price. That's exactly where price stalled from. It was a great short. Also, this was almost too perfect where price stalled right at that 200-day moving average. Next. Chart number 21, here's another daily chart. A little cleaner view. It shows you essentially the same thing. We're right at the June lows here. We bounced off of that on Friday. You can see how that, also that lower high here at 41.19. You had the perfect bearish moving average squeeze or pinch. It's a very objective short there. Next. Chart number 22, here's another chart. This shows this expanding pattern we've been showing. So under this, you got a wave 1, 2, 3, 4. And again, we had this in place way back when the S&P was up in here. And we're in this wave 5. Short term, what we could have here is a wave 1, 2, 1, 2, 3. So quite honestly, guys, from a bearish perspective, it looks like we're in a wave 3 of 3 of 5. So maybe we get a bounce here, wave 4, and then we go down again in this 5. And that would complete 5 of 3. So the point here I'm making is a bounce here is likely some sort of wave 4, not a major bottom. You know, unless you have some 90-90 up days, something like that. Overall, any good rally here, I'm expecting a lower high and down again. These could be targets, lower targets down this fall. Even down to this 3,200-ish area. Next. Chart number 23, here's that Rinko chart, nice clean chart. And just shows you the support levels quite well and wave counts. So you can see that was a big support area. That was lost. Then we lost this support, and we're basically back to this area. Next. Chart number 24, here's another daily chart. This shows that expanding diagonal. And you can see how it potentially measures all the way down to this area. Next. Moving down to smaller time frames, chart number 25, here's a half-day chart. Again, it shows you this expanding diagonal. We had that wave 4 high back up in here, the 200-day moving average. And it appears that we're in some sort of wave 3 here. So doesn't appear would be ending this downtrend. Maybe we get a little bounce here as a wave 4 and then down again as a 5. So I'm trying to let you guys know, if you do get a little bounce here, don't get all giddy on it. Next, chart number 26, here's the 2-hour view. Again, we bounced off this little support area from the June low. Again, let's say we get a follow-through bounce on Monday. I'm not expecting it to go that far. Maybe this downtrend line here, maybe fill this gap. Maybe down to here, but I'm expecting it to fail and then come down again. Next. Chart number 27, 60-minute view. Early last week, we said to watch for resistance at 3,900. Look at what happened. Price broke 3,900. It then came back to retest it as resistance. Perfect technical action of a broken support becoming resistance. On a 60-minute time frame, we got oversold, but look, there's no divergence, no positive divergence, none on the MACD, none on the RSI. So that, again, suggests your wave 3 trending type move. Next. Chart number 28, 30-minute view. You can see we had a little bear flag late last week, which played out. We're bouncing a little bit as of Friday. Again, I'm hoping we do bounce a little more, maybe fill this gap, and then I think we come down again. Next. Chart number 29, here's a 15-minute view, short term. You can see how we had a little measured move there, trying to bounce. Here's that gap if we were to get up into that, say, Monday. Finally, chart number 30, here's a 10-minute view. So this is one of our patterns we're watching for. Wave 1, 2, 3. We likely started some sort of wave 4 bounce on Friday, but it's one wave up. Maybe you get a little pullback as a B, and then up again. This is what I'm hoping. This would be a good short, because then I think, like I said, that's a 4. We come down again and a 5. All right. All right, guys, let's move on. We'll look at the triple Qs. Chart 31, here's the weekly view of the triple Qs. Again, just like the S&P, essentially testing their June lows right near the 200-week moving average. Now, the 200-week moving average is important. That tends to be a long-term pivotal area on the indexes, so we are pretty close to that. Next. Chart 32, here's the daily triple Qs. Again, like I said, back to the June lows here in this tight channel. Next. Chart 33, here's the daily KISS system for the triple Qs. Again, just like the S&P, you know, it's done its job this year. It stayed out of the market most of the time. And the longs it did take, it did get out at decent prices. And it's been in cash. By the way, we do have a DeMark 9 here at the lows as of Friday. You know, the last time we had a DeMark 13 before we had a bounce. And so something to watch. Next. Chart 34, here's the 2-hour view of the triple Qs. You can see this expanding diagonal. The head and shoulder pattern clearly played out. Again, no divergences down here, just oversold. All right, guys, so that does it for the major indexes. We'll see if we get a little follow-through bounce on Monday morning or so. Hoping we do, but I'm viewing that as a wave 4. Okay, I'm not viewing a major bottom here yet. Okay, just given the, you know, we're clearly in a trending wave 3 pattern. All right, let's look at some indicators. Chart 35, here's the VIX. The VIX did close outside of its upper Bollinger Bands on Friday, off the highs. Next. Chart 36, here's the CPC put-call ratio. It closed up here at 1.36, well outside its upper Bollinger Bands. That is quite extended, so we could be due for some sort of bounce fairly soon because of that. Next. Chart 37, here's the P Mcclellan Oscillator. Okay, it closed at the lowest level for this year. The same for the NYMO McClellan, which I'm not showing tonight. Okay, so it is very oversold. A lot of indicators are very oversold, but take a look at my comments here. So whenever the McClellan closes below its lower Bollinger Bands, you tend to get nice reversion to mean bounce trades. But your better trade bottoms occur when you have a positive divergence between the McClellan and the S&P. Okay, just like here. I mean, again, it wasn't a huge bounce. It lasted about a week, but, you know, just like here, you had a divergence here, here, here. We have no divergence here whatsoever. So that more suggests that any bounce we get here is likely just some sort of bounce. The better trade low will be when this sets up a divergence. Doesn't have to do that, but it's something to watch for. Next. Chart 33, here's the percentage of stocks that are above their 200-day moving average in the market. It's now down to 7.3%. Very oversold. Okay. The only time it was lower than this was back in March 2020 when it was at 3.1%. And by the way, that was the lowest ever. It was back in 2008. It never fell this low. So this is the second lowest on recording. So like I said, short term, we are very oversold. Next. Chart 39, here's another chart that shows you that we're quite oversold. This is the S&P. And what you got here is a couple indicators, percentage of stocks, or the new 52-week highs, new 52-week lows. Okay. So the new 52-week lows have now been closed above their upper Bollinger Bands for 6 consecutive bars. By the way, that is the most I've ever seen. So that's, you know, due to reset a little bit. Next. Chart 40, here's the NASDAQ with the same indicators, the highs and the lows, and of course the difference at the top. So both the difference and the new lows, they've been outside their Bollinger Bands for 6 consecutive bars. That's the most I've ever seen. So again, like I said, short term, we are quite stretched because of that. Again, you could have a one-day bounce that would literally reset that. So just realize that, guys, that doesn't mean you have a major bottom here. It just means short term, you're due for some sort of rally at any moment. Otherwise, what I said early in the year, back in January, I said, and I talked about this even back in December of last year, I said, in a bear market, this highs minus lows would likely stay below zero. And every time it got near zero, presented you with objective short opportunities. And look at that. I should have just done this all year. Every time this is the highs minus the lows got near zero was at every peak, every lower high this year. Take a look at that. Just perfect. Next. Chart 41. Here's another chart someone asked me to look at. This is the highs minus lows. They asked me if there's a divergence here. There is. The highs minus the lows. You can see last time we had a nice divergence at the June, July lows where the indicator was making a higher low. So right now we have the same thing. If the NASDAQ makes a new low here, this indicator will likely, be quite a bit higher. So you do have a technical divergence here. All right, moving on to bonds. Chart 42. Here's the yield curve, the 10-year divided by the 2-year. It fell 27.5% last week. It's now down at it's now back to levels not since the 1980s. Again, a vicious recession is coming, guys. No doubt about it. Next. Chart 43, here's the 10-year Treasury yield. Up strongly for the week. Now, it is likely to end on some sort of negative MACD divergence. That's something we're watching. Next. Chart 44, here's the daily chart again. Broke out last week and did pull back a little on Friday, but we are looking on that weekly to form a divergent high eventually. Next. Chart 45, here's the 10-year Treasury yield going back to the early 1980s. So essentially a 40-year chart. Again, we broke the 35-year downtrend channel early part of the year. That ended the bear market or the secular bear market in interest rates. Interest rates are now going to go up long term. You can see, in fact, that broken trend line acted as support there. Next target would be around this 4% area and maybe up around in the 5s. Again, guys, long term rates are going higher, but that's not a bad thing. That means that you'll be able to get a decent return on your CDs and bank accounts, stuff like that. Okay. For many years, savers have been punished, but interest rates are going to go up longer term now, and that will have a long-term effect on the stock market too, because you'll be able to get a decent return to more stable instruments. Back when the interest rates were 0%, that also helped fuel a lot of the speculative bubble in real estate and the stock market because you couldn't get any return in cash. Next, chart 46, high yield corporate. Ugly chart. These have really sold off this year. It's basically to this low, testing the June low with the market. Next. Chart 47, here's the daily chart again, testing the June low just like the market. Next. Chart 48, TLT, 20-year bond. This moves opposite of interest rates. So one thing we are monitoring is this weekly wedge pattern with MACD divergence. Again, you need a trigger, but bonds are down 27% this year. They've actually been declining since 2020, but they could set up a long opportunity down here on an eventual reversal. Something we're watching. Next, chart 49, here's the daily chart. Again, you need some sort of trigger. Short term, I would at least need to see price break over this downtrend line. Next, let's move to the market sectors. Chart 50 shows you a snapshot of 10 of the major sectors. I'm not going to discuss all the sectors tonight. We're going to look at a few individuals. Chart 51, here's oil services. So last week, to Steve's credit, last weekend, he showed oil services in a head and shoulder pattern. And boy, did that ever play out. Look at that. In fact, it looks much lower. Remember, guys, energy stocks were the strongest this year, but in a bear market, everything eventually gets hit, and that's what's happening now. Next, chart 52, here's XLE Energy, weekly chart. Last week we showed it as a bear flag, and that is playing out. Next, chart 53, here's the daily chart. You can see that bear flag playing out. Next, Chart 54, here's another chart. This is something to monitor, a longer term chart. We have an uptrend line from the 2020 lows. That comes in around 67.50. Next, chart 55, transports. Again, one of the major sectors in the market. This took out its June low just recently. See that bearish moving average squeeze you had back on that high. Next target could be the lower channel line. Next, chart 56, technology, weekly chart. Again, basically testing its June low. You can see the lower channel is quite a bit lower still. Next, chart 57, communication sector, containing a lot of those former FANG names like Facebook, Netflix. Of course, Google's on there, Disney. But boy, this is ugly. It lost this demand zone and now in free territory here. You do have a MACD divergence on the weekly time frame, stochastic oversold, but you would need to see some sort of reversal doji to have me interested at all to nibble at it. You can see that last rally stalled perfectly at symmetry. Next, chart 58, XLY, consumer discretionary. We showed it last week as a coil, which busted to the downside. Next, chart 59, financials, XLF. We showed it as a rounded top early this year, which played out. Lower high here now. This is a little weak support, but busting this, these could be your next targets over time. Next, chart 60, IYR real estate. Again, you know what's going on in real estate because of the rise in interest rates. 30-year mortgages that are now near 7%. You can see this triangle played out strongly to the downside. Next, chart 61, home builders, same deal. Home builders topped back here in December with a head and shoulder. Broke a support here recently. Next, chart 62, EEM, emerging markets. With that very strong US dollar, this area is obviously getting punished horribly. And let's go ahead and move on to the US dollar. Chart 63, weekly view of the dollar, up almost 3% for the week. Look at this move, going parabolic. Had a perfect double bottom back here in 2021. Next, chart 64, US dollar daily view. Short term, it's starting to go parabolic. Be aware of that. Next, chart 65, here's the KISS system for the US dollar, UUP. It's done very well. In fact, it showed a long back in 2021, and it's still long. Its DVT insurance stop is at 29.10 now. Next, chart 66, US dollar on the monthly view. Steve showed this last week. One target could be this upper channel line, wave 5. Again, that's if it stops there. You know, you wouldn't be very far away from this 2001 high. Next, moving on to commodities, chart 67, DBC. So we talked about this being a possible bear flag the previous couple weeks. You can see that's playing out. Here added an ABC target, which would be around 50% fib. Remember, guys, in a bear market, everything eventually gets hit. Next, chart 68, crude oil. Busted these support areas, as you can see. And you can see, guys, why divergence is not a buy signal. You had a RSI divergence, and that was blown out. That's why I left this in place, just to comment about it. Next, chart 69, natural gas, UNG. That's the ETF. We showed this as a head and shoulder pattern. That's obviously playing out. 200-day moving average could be a target below. Next, chart 70, copper. Bear flag has been setting up here. In fact, I've been showing the weekly chart in all my newsletters for a while because it just looked like a textbook bear flag, and that is now looks like it wants to play out. Next, chart 71, DBA, agriculture, also has a bear flag look to it on the weekly here. Next, chart 72, there's the daily chart, this wedge-like pattern starting to break that now. Next, moving on to cryptocurrencies, chart 73, here's Bitcoin. Now, Bitcoin's still hanging on to this kind of support area. Is it trying to build a base? We'll see. Again, if the market craps the bed, Bitcoin will get pulled down with it, but it is trying to hang on here. Next. Chart 74, here's the longer term chart, guys, before you get too bullish on Bitcoin. Now, my longer term target is down into here, down around this 10 to 12,000. You could see volume by price here. You could see how that's your big support area, as well as price. Over time, I think it does work to here. Next. Chart 75, Ethereum. Now, Ethereum leaking oil. It did break this support the previous week. Next, let's move to precious metals. Chart 76, gold. Gold is not at a good year. It was up early in the year, up to essentially a perfect double top near 2100. Selling off. It's now at its 50-month EMA here. The strong US dollar has not helped gold, obviously. Next. Chart 77, here's gold on the weekly. So, you know, it tried to hold this support area, starting to breach it a little bit. You have the 200-week moving average here. You know, we're a little below it. Again, price could also just recover, but it needs to recover now if it's going to. If it doesn't, this would be my next target right around the 1550 area. Again, the strong US dollar not helping it. The dollar needs to reverse, put in some sort of high before gold bottoms. Next. Chart 78, here's the daily view of gold, just keeping it simple. It's in this downtrend channel. It's been downtrending since March. Next. Chart 79, silver. It is holding up a little better, but it was down nicely on Friday. Next. Chart 80, GDX, gold miners, down 6.5% for the week. Again, it is quite oversold here. Ribbon's quite stretched. When these ribbons get stretched, usually you get changes, you know, you tend to get changes in the reversals, but we have yet to get that. We do have a little RSI divergence, but should it just continue to work lower, this would be your next support zones. Next. Chart 81, here's GDX on the daily. Again, the ratio here can never really get going. It's now at the bottom of this wedge. You know, is it going to find support here or just crater below it? We'll see. Next. Chart 82, here's the KISS system for GDX on our custom software. And it's done a damn good job this year. It went long there in February and got out in April at that DVT. They actually made a little bit of money. And it's been out ever since. It never tried to go long in any of these bounce attempts. Next. Chart 83, the last chart. Here's the bullish percent BPGDM. Been showing this for a while. This also did its job. I said you needed to see, for a confirmed buy signal here, you needed to see the Rinko confirm a buy. It never occurred. Never got over the parabolic SAR. It went on a parabolic SAR sell back here in April and has never attempted a buy. Okay, now the MACD did cross here. So what you will have is you will have a strong positive divergence once this finally does give a buy. And I think that'll be a good buy once you finally get that. But you can see this is now down at 6.9%. Remember, bullish percent charts can only go from 0 to 100%. So it's quite oversold. Anyway, guys, we'll see where futures open here later tonight, this afternoon. Have a wonderful rest of your Sunday and take care.